In today's video, we examine some common market cliches and see if they're actually silly sayings. Let's get into it. Hi, I'm Joe Macek, Portfolio Manager with IA Private Wealth, and your host of Investing Made Simple. And in today's video, we examine some common market cliches and sayings that you have probably heard a lot and determine if they're really worth adhering to. Because if you do any research whatsoever on investing your money, you are bound to run into some of the sayings on the internet that are widely accepted as the investment laws of the universe that should never be broken. And we're going to find out today if these cliches actually hold their own, why these sayings exist, find out if there's some common myths surrounding these nuggets of investing wisdom, and whether or not they are actually truly one-size-fits-all cliches, or if by listening to them, you could be worse off. By bringing to your attention some of the most common investing sayings, and hopefully detailing some scenarios where it might be wise to ignore said cliches, I also hope to show some examples of where these sayings could benefit you as an investor the most. And as a bonus, at the end of this video, I will share how it might feel to go through a true bear market and share a different perspective on how it might feel. So please, as always, stay tuned to the very end. But before we get into the video, I'd like to go through my usual disclaimer, which I put in written form to save time, but the long and the short of it is, before you make any decisions surrounding your money based on any video you see on YouTube, please take the time to consult with a fully licensed professional, or feel free to reach out to me on a one-on-one basis. The other thing you need to do is smash that like button for the YouTube algorithm, as it really helps out my channel. And if you love my content and want to be kept in the loop with all of my newest videos, I would really be thrilled if you would just hit that subscribe button and darken that notification bell. Now that we have that out of the way, we go into our first saying that has been widely accepted, but have you ever really thought about what it truly means? Time in the market and not timing the market is what builds wealth. This is probably one of the most overused and widely accepted market cliches ever to be said in the history of stock market investing. And today we're going to examine it very closely. We hear this saying all the time, but what does that actually mean? What is timing the market? I mean, have you ever took the time to look up what the actual definition of timing the market is? According to some definitions, timing the market is the act of moving in and out of a financial market or switching between asset classes based on predictive methods. Wikipedia defines it as the strategy of making buying or selling decisions of financial assets, often stocks, by attempting to predict future market price movements. The prediction may be based on an outlook of market or economic conditions resulting from technical or fundamental analysis. This is an investment strategy based on the outlook for an aggregate market rather than for a particular financial asset. Investing Answers defines it basically the same. Market timing is the practice of buying and selling securities based on economic trends, corporate information, and market factors. Okay, so call me crazy, but according to these three definitions, and many others by the way, if you do any research whatsoever or predictions based on that research, you are essentially timing the market. Which begs the question, doesn't virtually everyone time the market? I mean, when you look around YouTube, virtually everyone is making buying or selling decisions of financial assets, often stocks, by attempting to predict future market price movements. Doesn't the greatest investor Warren Buffett fit this very description of market timing? By selling his airline stocks and buying companies like Barrick Gold and making the giant shifts he's made in his portfolio, these are based on fundamental and predictive analysis. He is, by definition, timing the market, is he not?
Has Warren Buffett been timing the markets the whole time?
According to the definitions, the only way you could truly get away from timing the market is if you did absolutely no research and made absolutely no predictions as to what you bought. So you would buy the entire market or subset thereof, and I suppose if you did it in regularly timed intervals, regardless of the levels of the markets, until retirement when you would slowly withdraw that money, I guess at that point you would not not be market timing. But as we look at YouTube, we can see many examples of people who say they don't time the markets, yet there they are, by definition, timing the markets. And this isn't to suggest that these people are trying to deceive you, as I think by and large they give out very good and very trusted information. However, by doing research, picking a company, buying it and selling it all before retirement involves the very act of buying and selling securities based on economic trends, corporate information, and market factors, and the classic definition of timing the market. Now, before you all think that some of these awesome people could be somewhat hypocritical, as they all are telling you this age-old cliche while doing something else, I sure don't believe the definitions, and I don't think you should subscribe to them either. And no, these wonderful people out there, along with the great Warren Buffett, aren't sending contradictory messages at the same time. My definitions of timing the markets is vastly different than the definitions that are out there. Timing the market to me is trying to accurately predict money flowing into and out of the markets on an extraordinarily short time frame, hour to hour, day to day, week to week, and up to even quarter to quarter or even year over year. My personal opinion is that the ebbs and flows of the monies that go in and out of the markets on a very short time frame are in fact impossible to predict with any accuracy whatsoever, and this would be a much better definition of market timing, which is why most day traders that try to do this are unsuccessful, as they are following my definition of timing the market, and this is more aligned with gambling than investing. To give you an analogy, it's like trying to predict the waves that will happen in the ocean. They are very random, made up of tinier waves upon successively larger waves, and trying to figure out exactly how they will move next is pretty much impossible. Fundamental quantitative analysis used in predicting a company's success based on market trends, overall value, cash flows, and being patient in waiting for the company to execute on its business plan is not market timing. It's a repeatable, sound investment process that successful investors use in buying businesses over time. So if I were to revamp and improve that cliche to another one, it may sound something like this. Qualitative and quantitative analysis along with time in the market, not timing the market's short-term waves, can lead to building long-term wealth. And with that said, let's move on to cliche number 2. Missing out on the best days can be costly. Any so-called study that says if you miss out on the X amount of best days, you would be down X amount of percentage points and severely hamper yourself should be examined closely. Now, there are literally hundreds of these articles out there, but I will use the first one that crops up, which is the one quoted by CNBC, which says, when you sell in a panic, you may miss the market's best days. This article goes on to show you how much money you give up if you miss a certain amount of the best days in the market. And yes, there's that saying again. Focus on time in the market, not timing the market. According to this article, panic selling would result in a massive opportunity cost of missing out on the rebounds. And while I don't fully doubt the research, and if you happen to panic sell on the worst day, and if you didn't reinvest, there could be a case to be made there. But I think that would be very bad luck, and I don't believe that they have looked at the entire picture here, because the article doesn't mention anything about how much I would save if I missed the 50 worst days in the market. And wouldn't you know it, when I searched Google, I couldn't find a single article detailing what I would be up if I missed the 5, 10, 30, and 50 worst days in the markets. I mean, wouldn't it stand to reason that if my luck could be so bad, I mean horrible enough to miss out on only these so-called best days in the markets, could I not in theory also have unbelievably good luck when it came to missing the worst days in the markets? Logic would dictate yes. So why wouldn't anyone publish those numbers? I couldn't find a single article for the reverse case, but what I did find was very interesting. You see, the case could be made that this research could be very skewed, as shown by this article by the irrelevant investor. And in it suggests that by missing the best days, and I quote, this remarkable data point is almost always followed by time in the market beats timing the market. I'm generally on board with this line of thinking. However, I don't necessarily agree that this chart is the best way to prove this point. If by some miracle you managed to miss the 25 best days, you would likely have missed at least some of the worst days as well. This chart shows the rolling 30-day standard deviation of the S&P 500 with the 25 best days as green dots and the 25 worst days in red dots. You'll notice a few things. The best days often follow the worst days, and the worst days occur in periods of above average volatility. This would be represented by the red dotted line. These volatility spikes often happen in lousy markets, so it would stand to reason if you can avoid the very best days, you would probably also avoid the very worst days, thereby avoiding lousy markets. So you see, if the best days and the worst days are very close together, you can see why it would be a very tough thing to only miss the best days. This article goes on to show an even more interesting chart, which will probably change the way you think about avoiding downside risks. And again, I quote, "The chart below shows what happens if you were able to successfully avoid the 25 best and the 25 worst days. This would have put you well ahead of the index. Of course, this assumes perfect end-of-day execution, no transaction costs, and most importantly, no taxes, which we all know would never happen in real life, but hey, it's a chart following the same rules as the index, which has no rules when it comes to things like substitution and paying taxes. As you can see, missing just the best days in the market according to this data is very likely an improbable thing to happen, and is a cliche, dare I say a fallacy, to help convince you, the investor, to stay invested. This isn't a bad thing overall, but you may want to take this widely accepted cliche with a giant grain of salt. Which brings me on to my next cliche, the markets always come back. I wanted to talk about this cliche as many investors do believe the markets always do come back. And well, if it were up to me, I would change this cliche to say the markets almost always come back eventually. As when they do come back, it may be many, many years in the future, as in history we have seen several examples of the markets taking an absurdly long time to get back to old highs after they've made peaks. Perhaps the longest living example of this is the Japanese stock market, which peaked in November of 1989 at a level of 38,915 points and is still down at the time of this writing to approximately 28,000 points 31 years later. It took the Nasdaq about 15 years to get back to its old highs from the internet bubble in 2000, and in the Great Depression it took the Dow Jones about 25 years to get back to even after it collapsed in 1929. So when you see these charts, you know, the ones that say your average bear markets last X amount of months long, yes, it is true that we have been fortunate to have a fiscal and monetary policy that continues to work to keep the markets liquid and inflated with relatively short periods of bear markets. However, there could very easily be a time in the future where markets take an extraordinarily long time to return to a peak after a bubble. And the question you have to ask yourself is, would you honestly have had the patience to stay invested in a losing position for even a year or two, let alone over 25 years to get your money back? My guess is absolutely not. Just picture it. You invest your money at the peak today, and let's say that the market collapses and you're 25 years old, and the market will not get back to even until you are 50 years old. With that being said, understand that while markets can and do come back eventually, there is no guarantee of that, and it could take a very, very long time for this to happen. So with all that said, I will hopefully now give you a few words as a bonus, like I said in the beginning of the video, which will hopefully help you through the next severe downturn and what you might feel emotionally while going through it. This example expands on the chart of bull and bear markets, and we look to Einstein to help us use relativity to explain emotions during upturns and downturns. You see, when looking at a long-term chart of the index and looking at severe collapses that have happened in history, the pictures in the articles and the way the collapses have been described, you would have thought that the world was coming to an end. I mean, in 1987, it was an extraordinarily good example of a huge market collapse with people losing their minds, pictures of exhausted traders and stocks going no bid. Yet when you look at the longer term chart, no one thinks it's that bad. I mean, it looks like a tiny blip on an index chart. That's because when looking at past collapses, I would argue that you need to use Einstein's age-old analogy of relativity in order to feel what it might be like to go through the next one. Now, Einstein once said, and some of the quotes differ, but the general quote is as follows: When a man sits with a pretty woman for an hour, it seems like a minute. But let him sit on a hot stove for a minute, and it's longer than any hour. That's relativity. Now let's imagine for a moment that we translate this quote into describing bull and bear markets. I think you will get a very real sense as to how it might feel going through many months, if not years, of losing money, which as an investor you should be prepared for. When a person goes through a bull market lasting 7-10 years, it feels like a year or two, and it feels like you're having a good time. Very much like our example when things are pleasant. But put that same person through a bear market for 6 to 18 months, and it generally feels longer than any decade, similar to sitting on that hot stove. Having personally gone through 2000 and 2008 with clients, I can assure you that adding relativity gives you a very realistic sense of how true bear markets feel. And our latest 33-day bear market absolutely pales drastically in comparison to the 2008 financial crisis and the tech bubble of 2000, as both of those markets declined for years, a lot longer time frame, and had a much deeper route. In short, if you think the 2020 downturn was a regular downturn, it was exceedingly short by any other bear market in history. I would also say there's a huge difference between watching the market losing money and actually losing money hand over fist, and watching your portfolio decline month after month for 6 to 12 to 18 or even 24 months like in previous bear markets. Investors who have gone through a bear market like this are so dejected that they say at the bottom they never feel like the markets will ever go up again. While it can be tough to go through true bear markets, investors often do make it through them, provided that they have the resolve and the discipline needed. Hopefully, by adding the relativity example, it allows you to gain a unique perspective on these long-term charts. So I want to thank you again for tuning in at this time, and if you like the content, please hit that like button for the YouTube algorithm, as it really helps out my channel. And if you love my content and want to be kept in the loop with all of my newest videos, I would be very, very happy if you would just hit that subscribe button and darken that notification bell. Until next time, this is Joe Macek, Portfolio Manager. See you soon.